Rather, we think that returns on bonds will be probably in the 1% to 2% range over the next several years. And that's partly because of what I said before, that rates move up gradually. And that's because if rates in the US move up quickly, money will flow in from overseas, right? If our rates are much higher than the very low rates we see around the globe, you'll get cash flows into the US, pushing yields down and prices up. And by the way, that's also a reason that we recommend that clients who have tax-exempt portfolios diversify into global bonds to get the benefit of those different interest rate regimes.
Well, you know, you don't have to look too far back to appreciate the diversification and stability benefit that bonds bring a balanced account. As Seth pointed out earlier, it was just a year ago that markets were down sharply. A lot of people tend to forget that, even though it's not too long. You know, with global stocks down 10% and bonds up, that was really protecting balanced accounts from a lot of damage at that time, and importantly, keeping clients who own them invested in the market at a time when it really mattered. So Seth, let's come back to stocks. You had mentioned a minute ago that they don't look cheap by historical standards. So how do you find opportunity in that environment?
Sure. In fact, if you just look at where price to earnings ratios are today and versus the historic range, the price that you have to pay for each dollar of earnings is actually, it looks expensive by historic standards at about 17 and a bit more times earnings. However, you have to remember that historically, the average treasury yield for 10-year treasury was about 6%. And today, that yield is only 2.5%. So that's actually a very big difference. And there's a relationship, because if you look at all of the different interest rate regimes we've lived through in that history, you'll see that in general, when interest rates are lower, typically price to earnings ratios are higher. It does make sense. If your hurdle rate is lower, you are willing to pay more for stocks. So perhaps stocks aren't as expensive as some people fear, but they're definitely not cheap anymore. And I think that what really is going on, very much to Kathy's point, is there's been a nice rally because people are anticipating economic growth and good things happening from the new administration, but we really don't know yet. What we do know is that there's now a very important development, and that is that there's a lot more dispersion within the stock market than we've seen for a long time. In particular, a year ago when everybody was really worried about the economy, supposedly safe stocks that had higher dividend yields and were more stable were doing really, really well. And today, they've given back a lot of that return. By contrast, a lot of the more cyclical companies that depend on how the economy is doing, that are also, in general, beneficiaries of higher interest rates, and in some cases also could benefit from deregulatory initiatives or infrastructure investment or tax cuts that are currently being discussed. Those are the companies that are doing best now. And I think that that tells you something, which is that we're now in an environment where even if the overall stock market return is modest, you actually could do well if you know how to pick and choose where to play. In other words, whereas since the financial crisis, most of the time, it's really just been about, could you keep yourself in stocks at a time when that was not so easy to do? Today, it's really going to be more going forward about, can you be in the right stocks?
If I could jump in here, I think this is where it's so interesting, because there's a lot of movement that happened after the election that was very obvious, perhaps, like infrastructure stocks got very expensive. But lots of really attractive growth stocks that already have low tax rates did very little. So we know that there are going to be a lot of opportunities to use stock selection to unearth the wheat from the chaff as things unfold in the months to come. What's also very interesting to me is that when you pull this together, our forecasts for stocks have hardly changed since before the election. At the index level, we expect returns on US and global stocks to be roughly in the 6% range, and that's based on modest earnings growth in aggregate. Again, some companies much better than others, some companies worse. Modest earnings growth, good dividend growth, but no improvement in valuations because, as you said, they've gotten so high. In fact, we could even see some reduction in valuations, especially if rates move up faster than we think. So it's a very interesting time to look at stocks as a active manager, because the index we think will be rather modest in its returns, but we do think the opportunity to add value through stock selection is better than it's been in many years.
Well, you know that old adage about there's the stock market and then there's the market of stocks. That really seems apt here. And looking back, especially in the environment coming out of the financial crisis, it almost always is that kind of stock market call. But given the nature of the controversies that we've been talking about and the starting point with valuations across the market today, really does seem like there's an important inflection point occurring where it does become much more about individual security selection. I want to come back to what's happened in the aftermath of the election. You know, you mentioned that U.S. stocks have done reasonably well, but that's been less so the case when you look at markets outside of the U.S. Until, I guess, very recently. And you know, it's interesting, if you do look back over the last 8 years, U.S. stocks have rather dramatically outpaced their non-U.S. counterparts. So with some of the good news that we've talked about as it relates to the potential benefits from tax, regulation, and even fiscal spending, why then wouldn't the U.S. Stock market be the one to beat going forward as well? And so Seth, why don't you take that?
Well, I think that it's a really good point that we've had a great run in the United States. On the other hand, if you look at the pattern over time, what you find is that, in fact, there are extended periods when non-U.S. stocks beat U.S. stocks. For the 8 previous years, it was actually the foreign stocks that won by quite a big margin. I don't know, Kathy, if you want to get into...
Yeah, and when you think about it, the U.S. did better after the crisis because our authorities acted more quickly, right? Monetary policy was much more aggressive. It set the stage for U.S. earnings to recover. So we did indeed have a very strong U.S. recovery relative to the rest of the world. But circumstances are changing, and one of the issues, of course, is currency. If the dollar continues to strengthen, that will continue to benefit the earnings of non-U.S. exporters. Although the offset is, if you're a U.S. investor, the opportunity, when you translate gains in stocks back to U.S. dollars, that has a negative effect. So there's going to be lots of cross currents, but by and large, we think this is a very important time to have exposure to non-U.S. stocks. They are cheaper. There are a lot of trends that are in their favor, and the expectations are very low, setting you up for a good outcome.
Right. So Seth, our dynamic asset allocation services modestly overweight growth assets like stocks, and accordingly modestly underweight diversifying assets and stability assets like bonds. Talk a little bit about the research views informing that and what would need to change for us to reconsider them.
Sure. So remember that dynamic asset allocation is a service that we have that seeks to manage risk in portfolios while maintaining the returns of the portfolio at about the same level so that clients essentially can stay at the expectations that we've set for them in their plan. It's a lot like the shock absorbers in your car. The design is to smooth the ride over time. And what we're seeing today, because we do actually look at this literally every day in our portfolios, is an environment where we want to be very modestly overweight in stocks, especially non-U.S. stocks, for many of the reasons that Kathy was describing. Because in fact, when you look outside the U.S., international stocks are quite a bit cheaper than stocks in the U.S., and that reflects the fact that there are a lot of things people are worried about, but by the same token, expectations are low. And in many of these countries, there's actually a fair amount of economic policy stimulus, both monetary and fiscal policy, that's beginning to come through. So the likelihood of positive surprises, given the low expectations, we think is a bit better than most people would expect. And that means you want to take advantage of that. Now, on the flip side, although bonds are not going to deliver much in the way of return, as Kathy also mentioned, they're extremely diversifying at this point. So you also don't want to be too underweight bonds. And that result, when you add it all up, is an allocation that is very slightly leaning into non-U.S. stocks at the moment, but it could change. And we want to make sure that every day, as we look at the markets, we're making sure that we're being compensated for the risks that we're taking so that clients do end up with results that are in line with their expectations.
Okay. With all of this talk around uncertainty, I want to save the last question for this part of our program for Kathy and to talk a little bit about the ways we work with clients to bring confidence and clarity to their wealth strategies and the tools that we use that ultimately inform how we invest?
Yes, the world is always uncertain, and it is therefore absolutely critical to develop a long-term plan that you can stick to so that you don't get thrown off course by events that cause you to make a change and really dramatically impair your ability to reach your goals. We've used forecasting tools for a long time. We can never see around corners, but we can be informed by history to develop tools and models that let us think about all the ways markets can unfold over time, both good markets and bad markets and typical markets. And when we look back, we can feel pretty good about the fact that results actually come in pretty much as we expect over time, and time is what matters. So let me give you an example. In 2011, we would have advised a client with a moderate asset allocation that they should expect returns to run towards the 6% range over the next 5 years. Now, think back to 2011. That was the peak of the European debt crisis. People were very anxious. People didn't want to be in stocks, but someone who stuck with their allocation actually came out with returns in the 6% range. So it's just so critical to focus on the long term and recognize that there will be ups and downs along the way,
right.
But logic in markets tends to play out over time. The short run is always very different, but the long run tends to make sense. And that's why long-term planning really has a big role to play. It's very interesting now in that there are a lot of new things on the table. For example, any tax changes could really cause us to think about asset location, perhaps some changes for certain clients. We're all looking to see whether anything happens on the tax side. And of course, all the things we've been talking about will inform the way we think about planning going forward. It's a very important time to stay focused on the long term.
You know, it's interesting in a world that we live in where there are so many short-term forecasts out there, and as we talked about a couple of times now, 2016 was a great reminder on how unreliable many of them are. And in a lot of cases, people have a hard time actually understanding that the longer out you look, the more confidence you very often have in making a prediction. I think that's a great illustration of that. Okay, so Kathy and Seth, thank you. We covered a lot here today. Before we introduce Peter, let me try and summarize a couple of key points if I can. The first, I think, very clearly is expect the unexpected. Real economic growth in the U.S. looks likely to continue and could well accelerate in the face of improved business sentiment and potential policy changes as it relates to tax regulation and fiscal spending. But how far and how fast depends on a number of other variables that are uncertain at the moment, not the least of which is trade and how those things in turn could affect the dollar, interest rates, and inflation, all of which we're monitoring closely. But even with stronger growth, the second point is that returns ahead are likely to be lower than historical, given that stocks look moderately expensive and bond yields continue to be low. But to be clear, we continue to expect positive returns across these asset classes, but we see a bit more value outside of the U.S. And in non-traditional assets. In short, while the U.S. has been the place to be for the last several years, diversification still matters. And that's a good segue to the last point, which is that advice matters. In a world where returns are going to be harder to come by, wealth strategies are more important than ever. Questions around the capacity for spending, for charitable giving, and for generational transfer can all be reviewed and answered with an updated wealth forecasting analysis. You know, when we say we're in the business of money management, but what we do is make money meaningful, that's really where it all starts. So before we take your questions, I'd like to welcome Peter Krause to the studio. Peter is our chairman and CEO. Thank you for joining us today.
Glad to be here, Dave.
Good. Peter, you know, I just made the point that in a challenging return environment for traditional asset classes, advice matters. Now, the natural extension of that is who's giving advice really matters. So as we celebrate 50 years of serving clients, how do you think about what sets our firm apart and why does it matter?
Well, you said it. I mean, advice is key. And we all have worked a long time to gather financial assets, and we want to actually provide the best advice we can for those financial assets to benefit our families and ourselves over the remaining parts of our lives and our families' lives. So, key issue is, from whom do you get advice? There are many, many providers of advice. It's always hard to differentiate. Everybody has a particular view or a particular strength. But what's unique about Bernstein, I believe, amongst the rest of the world, is that we are not a middleman. We're not a manager selector. We are an investor. And as an investor, we're closer to the idiosyncratic risks. We're closer to the idiosyncratic stories of securities. And all the things that you've talked about in the last 20 minutes actually are driven by that and derived by that. And so if you're sitting in the room with the investor, you have a much better chance of understanding the risks that you're taking and the returns that you're trying to get, and how to address those concerns and how to allocate those assets. I think that's a key issue.
And there's a lot of efficiencies that go along with that in terms of our ability to manage risk and tax in real time, and the efficiency, and especially in a low return environment, in terms of the fees that ultimately investors are paying for the benefit of that advice, which is often misunderstood in our marketplace.
Yeah, you know, if you go to one place, you pay one fee. And what's often missed is that most other organizations, you pay a fee for advice, and then you pay a fee for the active management of the assets. Here, you're paying one fee that combines both. And I suspect that that's pretty efficient.
Okay, thank you, Peter. We've got, I'm told, a number of questions in the queue that are being displayed in a big monitor in front of us now. So let me take a look at the first one. Not surprisingly, it's about political risk and how we assess that and manage around it in today's environment. So Seth, maybe you could take a shot at that first.
Right. Well, we think it's pretty hard to anticipate political risk almost by definition, but we do plan for it very much along the lines of Kathy's discussion before about wealth planning. Our first line of defense is the long-term allocation. And as we build plans for clients, we're really thinking about making sure they reach their financial objectives even if very bad things happen along the way. In fact, we usually try to have 90% confidence or greater that plans will be achieved. And that's critical because it means that when there is something that's a surprise, it was already anticipated when the plan was struck. Now, on top of that, dynamic asset allocation helps smooth the ride by making sure that when risk is rising, and sometimes you can see it develop over time, we can make sure that we've smoothed that path so that your level of risk over time is less inconsistent. And finally, the benefit of having literally hundreds of research analysts who are looking at every single security in the portfolio and really trying to make sure that when we buy a bond or when we buy a stock, we know exactly what the risks are in that particular instrument, means that we have a better chance of avoiding some of the implications of political risk that you might get if you bought the whole market, say, through an index fund.
Okay, thank you. So we have a related question which ties to the low level of volatility that we're experiencing in the markets today at a time when there is all of this market and political risk. So Peter, with your global view, maybe you could give us some thoughts on that apparent inconsistency.
Well, it is an interesting fact that volatility is at historic lows at the present time. And I think most of us feel that there's a fairly uncertain political environment that we're entering into. Many changes, and those changes usually mean that investors will become somewhat concerned about the level of risk they're taking. The real challenge with low volatility is, of course, it changes the way that you measure risk. And it's actually very important to remember that when you're at low levels of volatility, that your risk measures start to look actually pretty benign. But in fact, when volatility changes, it moves very rapidly, much faster than you can react to. So at these times, it actually pays to be very careful about risk and actually assess your risk a little bit more carefully than you might otherwise, even in elevated levels of volatility. So our view today as investors is that actually we're very, very thoughtful about this, very concerned about this. And we look a lot at how do you actually measure risk in these time periods. And Seth talked about dynamic asset allocation. It's one of those things that actually has a big role to play in a period of time when you have very low volatility or very high volatility.
Right, right. And Kathy talked about the importance of time horizon as well, and being able to sort of weather those storms as they arise. You know, Kathy, you took a tough question on bonds earlier. I'm going to give you another one on hedge funds. Returns in the last couple of years for that asset class have been disappointing. So the question from the audience is, why do we still recommend them?
Hedge fund returns have been disappointing, there's no question about it. I would argue that some of the factors that have made it the market unusual, i.e. everything moving in tandem since the credit crisis, have affected hedge funds as well. Right. And therefore, as we get more dispersion in the markets, we should expect to see hedge funds benefiting from these different trends and trade-offs that we're seeing as well. There were a lot of anomalous things that hurt hedge funds' returns over the past few years, and they are dissipating. So I really think people should hang tough there, because we always know that there are cycles, and we think we're probably at the cusp of a change right now.
Okay. Peter, anything you'd add to that, just looking at that asset class?
Well, I agree with Kathy. I think we suggested that clients seriously consider hedge funds because they are a source of additional alpha that you do not get in the long-only part of the portfolio in equities or in the bond part of the portfolio. And so adding additional sources of alpha is actually a very good thing to do. They don't always produce that result. Over a long period of time, however, they have consistently produced that result. And most recently, i.e. in the last month, they've actually begun to perform. Too early to tell. But a short period of underperformance, which we've basically had 2.5 years, is not unusual in any manager or any group of managers. We know that managers go through periods of challenging performance and periods of strong performance. And what we look for is over time, the indications that we're actually providing and creating unique sources of alpha. And we still believe that hedge funds will do that.
Right. We have a question on municipal bonds that even relative to taxable bonds last year had low returns. So Seth, what were the dynamics driving that outcome?
Well, the major dynamic was actually the possibility that tax rates for individuals would be cut, because the relationship between a municipal bond yield and a taxable bond yield generally takes into account the tax rate of the people who hold those bonds, which obviously, if the tax rate is high, then the value of the tax shield that you get in the municipal bonds is high. If the tax rate gets cut, well, all of a sudden, the value of that shield has shrunk, so therefore the yield of the municipal bond has to rise, and that means the value of the bond goes down. And that was why we saw municipal bonds last year do so much worse than government bonds and corporate bonds that are taxable. Of course, at this point, the adjustment that municipal bonds have made essentially is pricing in virtually the entirety of what has been discussed as the administration's tax cut proposal, as if it's going to happen for sure.
Right.
And Kathy mentioned before, we do not know what will actually be proposed. We do not know whether what gets proposed actually is enacted into law, and even if it's enacted, we don't know exactly yet how it will be implemented, all of which could be surprises, as we were mentioning before. So we think municipals are actually an interesting place to be right now, because you've sort of priced in a worst case already, and going forward, you might get a tailwind if the tax cuts aren't as big as people currently expect.
Well, with interest rates low, we have another related question to that about building an asset allocation that generates yield at the portfolio level. So how do we think about that across the asset classes that we have at our disposal? Kathy, how about you?
So I'll start. First of all, let's recognize that some clients care a lot about income. Others don't. Others care about total return. But for clients who really care about income, we've been addressing that for several years now with rates so low.
Right.
So certainly there are different types of securities. There are high yield bonds, there are REITs, there are high income stocks that we can use to diversify away from a traditional bond portfolio to get the income that people want. Now, we also remind that that may yield a different long-term growth of the portfolio, because you may give us some appreciation to have that income, but we can clearly tailor portfolios to get the outcomes that our clients prefer. And absolutely, we have enough opportunities to add yield to portfolios where that is a desired outcome.
Right.
And for clients who are willing to take some illiquidity risk, there are also some interesting alternative investments that have very high yields in today's environment that may also be appropriate.
Yeah, without a doubt. There's a question also related to portfolio construction as it relates to geographic exposure. Kathy talked a little bit earlier about that in terms of bonds, but Seth, maybe you could talk about it in terms of stocks. And what's really the right mix going forward?
So for most clients, if you just think about the equity portion of your portfolio, our advice is to have roughly 70% of that in the US and about 30% outside the US. Now, if you look at what the market capitalization of the world is, the market capitalization overall is more 50-50, about an even split between US and the rest of the world. But we think the benefit of having a bit of a tilt to the US is that almost all of the clients that we work with intend to spend most of their money here in the US in US dollars. And if you have the same 50-50 split in your portfolio, then a surprisingly large amount of the risk you're taking relative to the money you're spending is coming from the very heavy currency mismatch you have between your investment portfolio and your spending stream. And about 70-30 ends up being the spot at which you're getting the full benefit of international diversification without excessive currency risk from that foreign currency exposure.
And you would also comment that U.S. companies many times source their income from foreign entities, and they're global, and you're getting some of that exposure too.
Mm-hmm.
The other thing about currency is that the cycles tend to be long, right? So you really have to make sure you're not positioning yourself in the wrong way for currency trends that could go on for many years.
That's right. Speaking of long-run trends, and one that we haven't seen in a while, Seth mentioned earlier that it was just a year ago that the idea of inflation was pretty much written off as something we'll never have to talk about again, but here it is back on the front page. So Peter, there aren't lots of people in our business who were at the height of their career the last time this was a discussion topic, but you were. So maybe you could talk a little bit about how you think about that today and really what the right way to build a portfolio with inflation protection on behalf of investors is.
Sure, no, that's a good point. I don't think that we're going to witness the type of inflations that the economy suffered through in the early 80s, or at least I hope we don't. I don't think there's any indication that would suggest that we'll be at 6% kinds of inflation. On the other hand, I think there's a lot of evidence to suggest that inflation is not dead, and that with inflation, you will get the diminishment of equity multiples because as rates rise, without commensurate growth, which you may not get, you actually get a reduction in the net present value of those cash flows. And so that generally has at least a headwind effect on equity multiples. So you want to have some exposure to assets that actually improve in a rising interest rate environment, which is going to be concomitant with a rising inflation rate environment. As Seth mentioned, that there are some investment opportunities that may not have liquidity, but actually have a lot of exposure, or what we call convexity, to rising rates. And that's a very attractive place to be in an inflationary environment. Of course, the secondary piece of that is commodities, but commodities are quite volatile. And so there's nothing wrong with having exposure to commodities, and we know that they're uncorrelated, but they're highly volatile. And in order to have that exposure and make it work, you have to be invested over the long run. And Kathy mentioned that currencies have long cycles, commodities even longer. And so you've got to be prepared to hold commodities even when you're not performing well, because you will not know when that turns.
Yeah, and I think that comes back to something Kathy said about both the time horizon, but also really getting your arms around individual circumstances, because the risk of inflation, the exposure to that, is not a generic statement. That really is specific to individual sets of circumstances at the investor level. So we have a question.
Yeah, that's
a
go ahead, very
Seth.
good point. So one thing we would want to do with clients is when we build a plan for them, figure out how inflation sensitive they really are.
Right.
And for clients who have significant inflation sensitivity, we would recommend both an inflation protection element in their bond and in their stock portfolio that would help make sure that if there is an inflation surprise, they will be able to meet their plan needs even so. And I think it's not a bad time to do that because inflation expectations remain surprisingly modest now. So again, it wouldn't take much for there to be an upside surprise. And in fact, our inflation portfolios over the last year have done quite well as a result.
Right. It's like any sort of insurance, right? The time you want to look at it is the time when you really don't need it.
Exactly.
So we have a question from the audience related to dividend stocks. And does the environment that we find ourselves in with all of this uncertainty argue for dividend stocks today?
So I would say really not. It's an easy reaction to have because it would seem that these companies are so safe, and by and large they are. The reason that they pay high dividends is typically because their businesses are very stable and throw off lots of cash that they don't need to reinvest in their growth. Often these are utilities or consumer staple companies, usually strong, good companies. The problem is that companies like that historically have traded at a decent discount to the broad market, typically about an 8% discount to the S&P. But over the past few years, so many people piled into these companies that they actually ended up trading at a very hefty premium to the S&P, almost a 25% premium at one point. Now, they have come back quite a bit. They've underperformed in the last 6 months, but they're still at a premium to the S&P. And so anything, even if it seems to be safe, can be risky if it gets too expensive, and we think they're still too expensive. That said, if you really, really care about income, it may be worth tilting into that a bit, along the lines of what Kathy described. Mm-hmm. But we're being very careful in those income-oriented portfolios not to take too much exposure to the highest yielding companies because we think they're still very exposed to the price risk.
Right.
Just to clarify, of course, we do own some very attractive high dividend stocks, but it's that we're very sensitive to valuation. So we want something of everything to make sure we're properly diversifying our clients' portfolios.
Right. I think that the point there is that the price of the insurance matters quite a bit.
Right.
Okay, so we have one last question, time for one last question, and I'm going to pose it to Peter first at sort of a high conceptual level, and then I'll ask Kathy and Seth to add some specifics. Question from the audience is, Bernstein has introduced several non-traditional investment portfolios recently. So the specific question is, what can we expect in 2017? I'd like, Peter, you to answer it more from the conceptual level in terms of how we think about those opportunities and what we decide to do, and just as importantly, what we decide not to do.
Sure. Well, as I said at the outset, we are investors. And as investors, we look to see if there are risk anomalies that we can exploit over the long run. And Kathy mentioned time horizons, and in this case, we think about 5, 7, 10-year at least time horizons at which we can exploit risk anomalies that occur either from structural change or anomalies that occur within the market between investors overvaluing or undervaluing securities. So in that instance, we use our research and we use the sort of history of the research that we have in the firm, and we won't be everything to everybody because that's not going to work. But we will and have identified certain structural changes and risk anomalies that we think we can take advantage of from our research and that we think are persistent, so we don't engage in timing, because timing is very hard to diversify.
Right.
And knowing when to get in and when to get out is challenging. So we would prefer to actually invest in something we think has a long time horizon, where the timing is not important. What's important is taking advantage of the structural change or structural issue that we see. So I suspect over the last 5 or 6 years, we've developed a half a dozen or more opportunities to invest in different areas, and we'll continue to do that. And I don't think that we have any prescribed number. So in 2017, we're not thinking we'll have 2 or 3 or 1. In some years we may have 3, and in some years we may have none. But it's driven by our research-oriented view and our critical analysis of where we think there are valuation fissures in the market to take advantage of, which are not temporal.
Yeah, I mean, as we think about this, I know from discussions we've had, the view is that these sorts of investment strategies really aren't a luxury, but a necessity, with how we talked about the challenges in some traditional asset classes and the opportunity to add income and diversification and even return. This is in a lot of places where you find it. So Seth and Kathy, I'll leave it to you to talk a little bit more about the specifics of what's on the horizon for 2017.
Start.
Sure. Well, we think that there are some opportunities for diversifying income that maybe for some investors is appropriate. You do have to lock up your money for some period of time to take advantage of this, because it is something that's generated by dislocations that currently exist in the credit market as a result of a lot of the re-regulation of banks after the financial crisis. That has allowed us to find ways to we think, get better yields than you could historically get from the public markets, and that it's done. We think it's a strategy that we can extend to more clients in the years to come. We think there's also some interesting alternative investments that are now available that take advantage of all of the uncertainty that we were describing earlier, that is going to create a lot of dispersion in the market and misvaluation of securities whenever surprises happen. And we want to make sure that we have strategies that can capitalize on that, again, for clients where that's appropriate. So we will certainly be having those conversations, and for clients who are interested, they should definitely reach out to their financial advisor over the year to see where it may make sense for them to add a little bit of that type of exposure.
Let me add, a lot of these strategies do require less liquidity to succeed, and therefore they're not for everyone, right? Some people really do need to have much more liquid portfolios. But happily, as Peter said, all of this is research-based, and many of the things that inform our decisions to develop these portfolios also work into our more liquid portfolios as well. So this is where this very big global research function that we have benefits all types of portfolios across the firm. And I think that's a really important benefit of the fact that we, as Peter said, we are the investors, we're not middlemen.
Well, Kathy, that's a great place to leave it here. As I said, we are out of time. These were terrific questions. I thank you for them. If we didn't get to yours, or if any of what we talked about raised an issue that is specific to your circumstances or your account, your Bernstein team stands at the ready. So on behalf of Kathy, Seth, and Peter, and everyone at Bernstein, thank you for tuning in, and good day.